Today we're going to talk about how Canada's new anti-house flipping rules are going to affect you as a real estate investor. What's going on, everybody? My name is Andrew, and today I want to talk about the new anti-house flipping laws that were implemented in Canada for 2023. There's a lot of questions going around about it for anybody who's looking to get into house flipping and wants to know what is the implications of this new rule as it applies to you personally and maybe corporately. For those of you that don't understand how taxes work for real estate, at least the basics and fundamentals of it, the basic thing you need to know is this. If you buy property in Canada and you own it for over 1 year, that means that you don't have to pay any taxes on any of the gains that you've made on that property. So if you buy a house for $500,000, you sell it for $600,000 over 1 year later, you don't pay any taxes. Now that is still the same as long as you declare your primary residence. Now what happens in the past if you sell a property in less than 365 days? Well, it's either if it's your second property or even if it is your primary residence but you don't own it for a year, you're subject to a capital gains tax, and that is taxed at 50% of the total gain. So if you made $100,000, then you're going to be adding $50,000 to your primary income. So imagine you're making $100,000 and then you sell your property in less than 365 days. Now you're adding $50,000 to your income, and that's going to put you at a higher tax bracket, and you might be paying like 40-50% taxes depending on what you're writing off and what you're not. Now here's where the change matters to you. What these new anti-house flipping rules are doing is that they're putting that capital gain into an income bracket of a business, meaning that if you sell the property in less than a year, less than 365 days, they are going to be categorizing that income as business income, which means it's not 50% of the total income that's going to be taxable. It's now 100% of that income is now taxable. So before, where you would only get taxed $50,000 on the 100 that you made, you are now being taxed 100 on the 100 that you made, which means that that's going to put you from $100,000 income to $200,000 income. You're making $100,000 from your job, and then you're also getting taxed $100,000 as part of your business income. That's a lot of tax to pay. You can be paying about $50,000 in taxes just on that portion. So what does this all mean to us as real estate investors, or for us who are looking to flip houses and want to make sure to protect our return on investment? Traditionally, we have always flipped properties through a corporation, meaning that we've always been paying corporate tax anyways. So these new rules actually doesn't affect us because we were declaring the whole income as business income anyway. And the way that we reduce certain taxes is that we are able to write certain things off and reduce our taxable income before we actually save the money. When you have a business, you're able to spend the income first and then pay the taxes on what's left, so long as you can write off the income. But when you're putting it onto your personal income, what you can write off is considerably more limited. Now listen, this is not going to be professional tax advice. This is just the general things that you need to understand, and I want you to make sure to consult an accountant accordingly, because what you need to know is that there are certain exemptions. If you are buying a house that you want to flip, you have a property less than 365 days that you want to sell, and there are certain exemptions as why you may not need to declare all that income as business income, and you can move it to capital gains, because this is essentially the distinction. The new anti-house flipping rules are essentially placing that profit margin that you're making, if it's under your personal name, it is now going to business income instead of falling under capital gain. And that is the main difference. You as a real estate investor now have to make a decision. Does it make more sense to put this property that you are flipping under a corporation, or does it make sense to do it under your personal name? And the main difference is that if you put it under your personal name, you can qualify for residential financing. And if you're planning on holding it for over 365 days, you could potentially declare your primary residence and then not have to pay any taxes on all the profit margins. But now you have a long flip instead of a short flip, where we've been teaching people how to flip properties in 3 to 6 or 8 months, and you could do 2 potentially a year. Now you're doing 1, but you are minimizing the taxes if you move into it. Whereas if you are established and you're doing a few flips a year, it is definitely more sensible to be now putting that income under a corporation, so that you're actually paying taxes on the business income, but at least if you're running it through a business, you can write more things off. So let me know what you think about these tax rules and how you're navigating them, or what you think it means to you. If you have any questions about how you should be structuring your next flips, make sure to get in touch with us, because we are doing coaching and consultations on how to flip houses right here in Canada.